In Phil Town's book, Rule Number 1, the author introduces a straightforward strategy that can empower anyone to navigate the complexities of the stock market and potentially accumulate wealth. The core principle, inspired by Warren Buffett, is to identify exceptional businesses, ascertain their intrinsic value, acquire their stocks at a substantial discount, and repeat the process systematically. These summaries guide you through the key elements of this strategy, providing insights into 1. Recognizing exceptional businesses. Discover the crucial indicators that distinguish outstanding businesses, offering you a practical framework to identify lucrative investment opportunities. 2. Challenging market efficiency. Challenge the common belief in the market's efficiency by understanding why certain stocks may be mispriced, creating opportunities for astute investors. 3. Rethinking portfolio diversification. Gain a nuanced perspective on the myth of a diversified portfolio as a foolproof strategy, and learn how a focused approach aligned with Rule Number 1 can be more effective. By delving into these summaries, you'll gain valuable knowledge on how to apply Rule Number 1, empowering you to navigate the stock market with confidence and potentially unlock financial success. Debunking investment myths. Unleashing your potential to beat the market. Investing in the stock market is often perceived as a realm reserved for financial experts, but Phil Town challenges this misconception in Rule Number 1. This summary explores the idea that you don't need to be a seasoned professional to excel in investing and beat the market. In fact, with the right tools and tactics, individuals can leverage the wealth of information available on the Internet to make informed investment decisions. Key points. 1. Digital tools and information. The Internet provides accessible tools and vast financial data, enabling individuals to navigate the stock market without relying heavily on expert advice. Websites like MSN Money, Yahoo Finance, CNN Money, and www.rule1investing.com offer valuable resources and investment calculators. 2. Technology's impact. Technological advancements have equipped investors with more accurate tools than ever before, surpassing the capabilities available a decade ago. These tools enhance the precision of financial analysis, empowering individuals to make well-informed investment choices. 3. Beating the market. Challenge the efficient market theory, EMT, which posits that stock prices already reflect all available information. Historical events, like the 1990s bubble, demonstrate the market's susceptibility to mispricing, debunking the idea of an unbeatable market. Warren Buffett's success further supports the notion that individuals can outperform the market over the long term. By embracing these insights and discarding common investment myths, individuals can embark on a journey of successful investing, leveraging available resources to make strategic and informed financial decisions. Rethinking investment strategies. Beyond, diversify and hold. Summary. The commonly touted investment strategy of diversify and hold is often considered a safe approach for navigating the stock market. However, this summary challenges this notion, highlighting the historical shortcomings of this strategy and proposing an alternative perspective. Key points. 1. Flaws in diversify and hold. The traditional strategy of maintaining a diversified portfolio and holding onto investments for the long term has its drawbacks. Historical analysis reveals that this approach would have yielded a zero rate of return during significant periods, raising questions about its effectiveness as a foolproof investment strategy. 2. Active monitoring for improved security. Instead of blindly diversifying and holding, the suggestion is to actively monitor all invested stocks. Maintaining a keen awareness of the performance of individual stocks allows investors to react promptly to market changes and potential losses. This contrasts with the challenge of comprehensively understanding and monitoring a diversified portfolio. 3. Industry expertise and quick response. A key advantage of closely tracking individual stocks is the ability to leverage industry expertise. Investors who understand specific business sectors can make informed decisions quickly, especially in response to critical events such as recalls or significant market shifts. This proactive approach can be more effective than a diversified strategy in which the investor may lack in-depth knowledge across all holdings. 4. The downside of blind diversification. Blindly diversifying a portfolio may expose investors to market trends without providing the ability to respond swiftly to emerging challenges. The analogy of a pharmacist receiving crucial information about a pharmaceutical company's product highlights the importance of industry knowledge in making timely decisions. 5. Market impact on diversified portfolios. Diversification does not shield investors from broader market trends. When a significant amount of money is withdrawn from the market, mutual funds values decline, triggering a cycle of further withdrawals and accelerated value drops. This scenario, especially concerning as baby boomers approach retirement, emphasizes the potential risks associated with blind diversification. In essence, the recommendation is to move beyond the conventional wisdom of diversify and hold, and adopt a more active and informed approach to investment, leveraging industry expertise and closely monitoring individual stocks for better long-term outcomes. Invest like an owner, a strategic approach to stock investing. Summary: shifting the perspective from mere stock ownership to considering each investment as if buying the entire business, this summary advocates for a more thoughtful and cautious approach to investing. The key principle is to invest only in businesses you understand and would genuinely like to own in the long term. By adopting this mindset, investors can make more informed decisions, avoid unnecessary risks, and align their investments with personal values. Key points. 1. Invest as if buying the entire business. Instead of viewing stocks as mere tradable assets, consider them as ownership in a business. This shift in perspective encourages investors to evaluate potential investments with the mindset of owning the entire company. This approach leads to more careful consideration of the company's performance, history, and management. 2. Long-term ownership mentality. Shrewd investors focus on businesses they would be comfortable owning for the long term. This mindset helps in avoiding impulsive decisions based on short-term market fluctuations. By approaching stock investment with a long-term ownership mentality, investors make more thoughtful and strategic choices. 3. Caution against risky ventures. Viewing stocks as potential long-term ownership dissuades investors from opting for risky businesses or being swayed by isolated growth rates. The emphasis shifts to a comprehensive assessment of a company's overall performance and viability. 4. Sector-specific expertise. Investing in a sector within one's field of interest and expertise enhances decision-making. Professionals working in a particular industry, such as IT, are better equipped to assess companies within that sector. This specialization allows for a deeper understanding of market dynamics, product quality, and industry strategies. 5. Consideration of ethical impact. Beyond financial considerations, investors are urged to weigh the ethical implications of their investments. Considering whether a business aligns with personal values and ethical standards becomes crucial. This approach prevents investing in companies engaged in practices that conflict with one's principles. 6. Investment as a statement. Every investment choice is considered a statement of support for the company's operations. Investors are reminded that their financial contributions can have an impact, reinforcing the idea that investing is not only a financial decision but also a moral and ethical one. In essence, the recommended approach is to invest with the mindset of a business owner, prioritizing understanding, ethical considerations, and a commitment to long-term value creation.
Thank you for fueling my engine with your likes, shares, comments, and subscriptions. Your unwavering support until the end demonstrates your dedication to personal growth and wisdom. Your contribution not only broadens the channel's influence to a wider audience but also plays a vital role in nurturing its continuous development. As a token of gratitude, I pledge to consistently deliver insightful book reviews sourced from some of the most impactful books in the world. Thank you for being an integral part of this enriching journey. Make sure to stay tuned till the end for more insightful nuggets, and don't forget to provide us with your feedback. Thanks for being with us. Now, let's get back to the review.
Unveiling market moats, a strategic guide to identifying strong investment opportunities. Summary: companies that possess unique competitive advantages, often referred to as moats, are better positioned to withstand market challenges, dominate their sectors, and provide sustainable returns for investors. This summary explores various types of moats that contribute to a company's resilience and profitability. Understanding these moats can guide investors in selecting businesses with enduring strengths and potential for long-term success. Key points. 1. Intangible competitive advantages, patents, trade secrets. Companies with moats often possess intangible assets like patents or trade secrets that create significant barriers to competition. For example, Pfizer's patent for Viagra provided a legal monopoly, preventing direct competition and ensuring a dominant market position in sexual enhancers. 2. Strong brand loyalty. A powerful brand that resonates with customers and fosters loyalty acts as a moat. The example of Coca-Cola illustrates how a well-established and widely recognized brand can influence consumer choices, contributing to the company's stability and market dominance. 3. Cost leadership. Moats can also manifest through cost advantages, where companies can offer products at competitive prices. Retail giant Walmart, due to its immense size and bargaining power with suppliers, can maintain cost leadership, attracting customers with affordable goods. 4. Switching costs. Some moats arise from the inconvenience or difficulty associated with switching to alternative products or services. Operating systems like Microsoft's Windows, despite user dissatisfaction, benefit from the exclusive software compatibility, making it challenging for users to switch without significant disruptions. 5. Market exclusivity, legal monopoly. Certain companies enjoy moats through legal privileges that grant them exclusive governance over a market. For instance, utilities like PG&E may have a legal monopoly to provide power in specific areas, shielding them from direct competition. Understanding these different moats equips investors with the knowledge to identify companies with inherent strengths and competitive advantages. Investing in businesses with robust moats increases the likelihood of long-term success and resilience in the ever-evolving market landscape. Indicators of a wide moat, ensuring long-term success. Understanding whether a company possesses a wide moat, indicating its competitive advantages, involves analyzing specific indicators consistently over an extended period. Here are key indicators to assess a company's competitive position. 1. Return on investment capital, ROIC. Definition. ROIC measures the rate of return a company generates from the money invested in itself within a year. Example: if a company invests $20 in stamps and later sells them for $30, the profit is $10. The ROIC is calculated as the profit divided by the total investment, resulting in a percentage, e.g., 50%. Indicator for a wide moat. A company maintaining an ROIC of at least 10% over 10 years suggests a sustainable competitive advantage. Consistent high returns can indicate a strong market position and effective use of invested capital. 2. Equity growth. Definition. Equity represents the remaining value if a company sells all its assets and settles all debts. Indicator for a wide moat. A consistent annual equity growth of 10% or more for 10 years signifies a company's ability to accumulate resources for expansion. Growing equity reflects financial strength and competitiveness. 3. Sales growth. Definition. Sales growth measures the increase in a company's revenue over time. Indicator for a wide moat. Sustained sales growth over 10 years indicates the company's ability to expand its market presence and attract customers. It suggests effective strategies and demand for its products or services. 4. Free cash flow, FCF. Growth. Definition. Free cash flow is the surplus cash generated after covering operating expenses and capital expenditures. Indicator for a wide moat. Consistent growth in free cash flow over a decade demonstrates the company's financial health. Positive FCF growth enables investments in innovation, acquisitions, or returning value to shareholders. 5. Consistent earnings per share, EPS. Definition. Earnings per share represent a company's profit allocated to each outstanding share of common stock. Indicator for a wide moat. A stable and increasing EPS over 10 years reflects the company's profitability and potential for sustained success. It indicates effective management and adaptability to market conditions. Assessing these indicators collectively provides a comprehensive view of a company's competitive advantages and long-term viability. A company demonstrating strength across these metrics is more likely to have a wide moat, ensuring its ability to thrive amid market challenges. Calculating competitive advantages, assessing a company's moat. Determining a company's competitive advantage involves straightforward calculations based on key financial metrics. Here are 3 essential calculations to identify a wide moat. 1. Earnings per share, EPS, growth rate, calculation. Determine if a company has experienced at least a 10% increase in EPS over approximately 10 years. Example, if a restaurant's EPS grows from $20,000 to $160,000 over 10 years, calculate the average doubling time using the rule of 72. In this case, the doubling time is 3 years. Divide 72 by the average doubling time, 72/3, yielding a 24% EPS growth rate, indicating a competitive advantage. 2. Sales growth rate, calculation. Assess whether a company's sales consistently increase over 10%. Example, if Garmin's sales double 3 times over 9 years, with a doubling time of 3 years, apply the rule of 72/3 to obtain a 24% sales growth rate. This indicates Garmin's wide moat and competitive advantage. 3. Free cash flow, FCF, growth rate, calculation. Check if a company maintains a free cash flow growth rate consistently over 10%. Example, Garmin's free cash flow grows from $40 million to $130 million in 7 years. If it doubles just under twice in 7 years, with a doubling time of 3.5 to 4 years, apply the rule of 72 quarters. This results in an 18% free cash flow growth rate, highlighting Garmin's profitability and competitive advantage. These calculations provide a quantitative assessment of a company's ability to sustain its competitive position. A consistent positive trend in EPS, sales, and free cash flow growth rates suggests a wide moat, indicating the company's resilience and potential for long-term success. Selecting companies for investment, the importance of CEO characteristics. In addition to evaluating a company based on the Big 5 criteria, Rule number 1: investors emphasize the significance of the CEO's qualities. The effectiveness and characteristics of a CEO can significantly impact the company's long-term success. Here are key attributes to consider when assessing a CEO. 1. Owner-oriented leadership. Definition: an owner-oriented CEO prioritizes the long-term interests of the company and its shareholders. They make decisions that benefit the company's overall health and inform shareholders about relevant matters. Signs of owner-oriented leadership: transparent communication, especially during challenging periods. Avoidance of actions that may inflate short-term stock prices at the expense of long-term company health. 2. Transparency and communication. Importance: shareholders need to be well informed about the company's performance and any challenges it faces. Transparent communication from the CEO allows shareholders to make informed decisions. Example, an owner-oriented CEO communicates openly about both successes and challenges, ensuring shareholders have a comprehensive understanding of the company's situation. 3. Long-term vision. Definition: a CEO with a long-term vision sets ambitious goals for the company's growth and works toward achieving them. This orientation contributes to sustained profitability and increased company value. Signs of a long-term vision: setting and communicating ambitious, long-term goals. Reminding employees of these goals to inspire commitment and effort. 4. Drive and dedication. Importance: a driven CEO is committed to the company's success, working persistently to ensure profitability. This dedication positively influences the company's overall performance. Example, Darwin Smith's dedication to transforming Kimberly-Clark into the world's top paper-based consumer products company exemplifies the impact of a driven CEO. Assessing a CEO's characteristics provides valuable insights into their commitment to the company's success and the potential for long-term growth. A CEO who prioritizes the interests of shareholders, communicates transparently, and demonstrates a long-term vision is likely to contribute to the overall success and value of the company. Ensuring investment safety. The significance of a margin of safety. In the realm of rule number 1 investing, understanding the difference between a stock's price and its value is crucial. While the efficient market theory suggests that prices reflect the true value of stocks, rule number 1 investors disagree. Instead, they emphasize the importance of buying stocks when there is a significant advantage, a principle known as demanding a margin of safety. Here are key insights into the concept of a margin of safety and its role in rule number 1 investing. 1. Price versus value. Clarification. Price refers to what you pay for a stock, while value is derived from the money a business generates over time. Importance. Understanding this distinction challenges the idea that market prices always accurately reflect the intrinsic value of stocks. 2. Assessing stock value. Challenges. Determining the true value of a stock can be complex, involving considerations of a business's future earnings per share, EPS, and price-earnings ratio. Tools and resources. Online tools, such as sticker price calculators, can assist in assessing stock value. 3. Market inaccuracy in the short term. Example: in the late 1990s, prices for precious metals dropped significantly, but their intrinsic value remained. Savvy investors took advantage of the market inaccuracy, bought shares at low prices, and profited when demand rose again in the early 2000s. 4. Margin of safety, MOS. Definition. MOS is the difference between a stock's value and its price. Rule of thumb: a good MOS should be at least half the value of an investment. Example: if a stock's value is $40 per share, a rule number 1 investor would consider buying only if the market price is $20 per share or lower. 5. Preventing losses in bubbles. Role of MOS. Demand a large margin of safety as it not only enhances returns but also protects against losses in market bubbles. Example: in the dot-com bubble of 2000, Nasdaq stocks that crashed had prices higher than their actual values. Demanding a substantial margin of safety is a fundamental principle in rule number 1 investing. It serves as a protective measure, ensuring that investors only enter the market when the price of a stock provides a significant buffer against potential losses. By adhering to this rule, investors can navigate market fluctuations with a focus on long-term gains and risk mitigation. Smart investing made simple. A recap of rule number 1. The book, Rule #1-inch, provides a practical guide to smart investing, debunking the myth that one needs to be a financial expert to navigate the stock market. Here's a concise summary of the key insights. 1. Accessible investing. Myth busted. Contrary to the belief that investing requires expertise, the Internet provides accessible tools and data for anyone to make informed investment decisions. 2. Rule number 1 investing principles. The rule: find a wonderful business, determine its value, buy its stock for half that value, and repeat until rich. Key indicators: ROIC, equity growth, EPS growth, sales growth, and free cash flow growth are crucial indicators of a company's competitive advantage. 3. Choosing the right CEO. Owner-oriented CEOs. A good CEO informs shareholders honestly, avoids short-term gains at the expense of long-term health, and is driven to achieve long-term goals for the company. 4. Demanding a margin of safety. Price versus value. Prices and values are not always aligned. Understanding the difference is crucial. Margin of safety, MOS. Buy stocks when the price is at least 50% lower than their real value to ensure a buffer against market fluctuations. Preventing losses. A substantial MOS protects against losses during market bubbles. 5. Practical advice. Smart monitoring. Check the market when it's closed, preferably at the same time each night, for consistent and less emotionally charged data. In essence, Rule #1-inch empowers readers to take control of their investments by leveraging available tools, understanding key indicators, and applying fundamental principles. It emphasizes the simplicity of investing intelligently and building wealth steadily. Remarkably, 88% of our audience hasn't participated yet, prompting a gentle request for your support. If you discover even a hint of value in our content, we would genuinely appreciate your support through likes, shares, and subscriptions. An earnest expression of gratitude for your steadfast presence with us until the end. Thank you, and check out my channel for more.